Bell rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
I'm the senior trader for the Forex Super Model. I've been asked to do a series of videos on how we trade the models. And the first part is this you? Can you give me some room here? It's bad enough that I have to slum it down the lab. Can't be cramped up. You're going to have to go. That's better. I've got a bit of elbow room now. Right, part one. Is this you? Now, when we're looking at how to trade the models, we need to first look at how most other people trade. And the best way to start is to look at this then. So, in our view, most people trade something along the lines of this. They have a plan, if they're not complete, wingers, then they have a plan. So they plan to go they plan for an entry. So they have an entry, and the entry is based on some form of analysis, be it whatever they want, be it technical, fundamental. Normally a lot of people are using technical indicators and what have you. It doesn't really matter. They've got a plan, they've got some analysis, and they've got an entry in mind, and then they decide, well, they're going to go short or long a particular financial instrument. So let's say we're talking about the euro dollar. So euro dollar, we're looking at, let's say we've got a plan to go long the euro dollar, and then they'll say, right, okay, get the chart up for the euro dollar, look at the different time frames. I'm a sophisticated trader. I use multi-time frame analysis, I use the economic calendar, I use all this stuff, I use indicators. Anyway, we get to the point. Everybody gets to the point where they say, yes, it has fulfilled my criteria, I am going long, I am clicking the button, here we go. So they enter the market, so the entry, and they're going long. So in that they have a plan that they think that, so they have a worst case scenario, so they have a stop. Yes, they use stops, these people. They have a stop, and then they have a target, or they call it a TP, a take profit. TP, take profit. And then so we're up and running, we've entered the market. We go back a bit initially because of the spread. So, you automatically in the red. So you've got your spread, and then you're up and running, and then all eyes are glued on the euro dollar. We're completely fixated with the euro dollar. We're watching every tick. It starts to dirge around, and then it starts to go up. So it goes up. Now the further it goes up towards our TP, take profit, the happier we are. So this is the happy zone. We're happy. So it's the happy zone. Because we're happy, because we're starting to make money, we've overcome the spread. The screen's starting to go blue. Happy days. There we are. So all we need now is for it to keep chunking up and to hit our take profit. We're out. Good job. We're the best trader in the world. Now, what's the alternative here is it starts to go down. So we've already lost a bit on the spread. Now it's going increasingly red. We're not liking it. So this is our not happy zone. All right, not happy. Not happy zone. We're losing money on top of the spread. How outrageous is that? The screen's red. We're feeling a bit, you know, uncomfortable. It's not hit our stop yet, but it's not great. So we're not feeling happy. It's unhappy. So, and then eventually, let's suppose it chunks down and hits our stop. We're stopped out. The trade's now gone. Our account has been debited the amount, and we're out of the market. So again, what most people do here then is they've got in their trading plan, let's suppose the euro dollar, they say, well, we'll give it a bit of swing, so we'll give it a 30-point stop, say, maybe, well, that's quite a big stop for most people actually, but let's say 20. So 20 points here from our entry. If it goes lower, 20 points from our entry, we're stopped out, and then that's it. And then let's suppose our take profit is so that's minus 20 points. Let's suppose our take profit is plus 40. Now here's another interesting thing. Because we're told most traders like to have a 2-to-1 risk-reward ratio at least, so greater or equal to 2-to-1. So they risk 1 unit and they're expecting to gain 2 units. So what could be better than that? You only have to win 50% of the time and you're still significantly up. So that's another thing. That's what they want to do. They want a 2-to-1 ratio. So in this case, if we risk 20 points on the euro, our take profit will be 40 points higher. So that's, and if our take profit's 60 points, obviously then our ratio is 3-to-1, etc. So and then to calculate their ratio, most people are told to look at the ATR, the average true range. So if they look at the average true range for their particular instrument over the time frame that they're interested in, then let's suppose that the euro average true range is, I don't know, for ease 100 points for the day. So on average the euro has a range of 100 points, and they you know, if they get in after it's only gone down, say 40 points, then there's 60 points of the range to go, and they're only after 40 or at the most probably 40 points. So it all seems very sensible, and that's the way a lot of people trade. And then you factor in all sorts of other stuff, like maybe once it starts going, they move their stop to break even, so it's the break even point stop. You know, so which will be here near their entry, just above their entry, and then you can use trailing stops, and you can muck about with trades, but basically that is that the scenario. Now, so what's the psychology of that? If it goes my way, I'm happy. If it goes against me, I'm still happy because I've got a plan and I've basically managed the risk. I know that if it doesn't go my way, the most I'm going to lose in theory, unless it gaps and really shafts you on the stop, which let's assume that doesn't happen. That wouldn't be nice. But let's assume you stop holds, then I know I'm gonna risk 20 points. And the other conventional wisdom that is this is they don't like to risk, or people don't like to risk more than 1% of their account on any given trade. So 1% equals max at risk max risk per trade. Right. Again, does that sound like you? Maybe. Now, and you can get a little bit more sophisticated than that, and you can say, I'm going to have no more than 3 losses, so that my account's not going to go down more than 3% in any one day or week or whatever you want to say, so that I can, if I'm completely out of sync with the market, which effectively means you're losing, you can be out of sync with the market and still winning. But let's not worry about that. Let's just say 3% will be my maximum drawdown in a given period, and therefore I'm managing the risk, and I can have lots of these 1%, 3% drawdowns and still have an account at the end of the day. Although you've only got to have 3 of those and you've lost 10%, so roughly 10%. Anyway, so that's, I know that is this you or is that you moment. Now, with regards the Forex Super Model, we do not really trade like this. This is a sort of a naked version of trading, if you like, and by that I mean that you have a single trade punching away either short or long, and you live or die by whether it hits your TP, your take profit, or your stop. Now, there's all sorts of other things that people mess up as well. They sort of, when the market gets near their take profit, they start getting a bit twitchy and say, well, maybe it won't quite hit it, so I might as well take it. It's 90% near my take profit, so I'll take it. And that's reduced maybe my risk reward down to 1.9 to 1, but hey, it's close enough, and I won't be doing that every time anyway. So that's the first thing. And maybe if it's nearly hitting your stop, you might say, oh well, to hell with it, I'll take the trade out anyway, and then of course it'll go back up or whatever. Or even worse, you move your stop down a bit because you think, oh, it's a bit tight, and then I can get over this because I've moved the stop down another 10 points, so we can lose 30 points, but there's room in the trade to make 60, so I'm still in my 2-to-1 ratio, so everything's fine. I'm not breaking my rules really, but all this comes down to, is this you? Probably, if you've been on a course or you've read some books or been on the internet. Now, that's a good place to put your thinking cap on and think, yes, that is what the majority of traders are doing. If it's not you, then congratulations, but you're not in the majority. This is what the majority of traders are told to do. They're told to have a trading plan, a take profit, a stop, and they're told to have risk rewards that are greater than 1-to-1, etc. They're told to have maximum amounts of risk to their account size, and they're told all sorts of other guff as well, like trade with the trend, find a trade where you've got higher highs and higher lows, that's an uptrend. So that's what we would have wanted to do there, probably if we were the default trader. So we'd be saying, yes, we're in with the trend, we've got a good entry, and the data is in our favour, etc., etc. There we are. Is that you?